So Jeff, when we saw the STEMI money hit, let's say pandemic, and then we saw the inflation come, I think we peaked around June of 22, I believe it was. The Fed reacted with the high interest rates to combat inflation. And now we're sitting in this, I don't know if it's going to be temporary or not, this kind of high inflation due to this oil issue with Iran and the fact that we're over there. What do you see next? Because a lot of people are hanging on lower interest rates.
Yeah, lower interest rates are still coming. The question is what central banks will do in the meantime. Historically, oil shocks always go in one direction. It's not inflation. Even in the 1970s, the twin oil shocks in 73 and 79 were not inflationary. We already had the great inflation established. By the October 1973, with the first OPEC embargo, the great inflation was already almost 8 years old by then. People don't realize that. People think the great inflation started in 1973 with oil. Now, what oil did is it made the temporary consumer price rates go way up, and then they went down again temporarily before the great inflation came back in the middle part of the 1970s. So what happens in an oil shock, we saw this in 1990, which is probably a very good example. In 1990, you had a relatively weak economy that was already on the edge, very close to the edge of recession to begin with. There was the S&L crisis that turned into a credit crunch, and then Saddam Hussein invades Kuwait. Oil prices go from $15 a barrel to 40 in 3 months. And next thing you know, before the end of the year, the U.S. economy is in full-blown recession with unemployment rising. And what happens in interest rates during a recession? Interest rates go down. But there's this short run uncertainty. I hate to use that term because it's overused, because you can end up like 2008. People forget in 2008, the European Central Bank, which should live in infamy here, the European Central Bank raised its policy rate in July 2008 because it was worried about oil prices being inflationary. The worst deflationary crisis we've seen since the Great Depression. And here was the ECB overreacting to oil prices by raising its policy rate. This was 4 months or nearly 4 months after Bear Stearns, almost 2 months or just a little over 2 months before Lehman Brothers. And here are central bankers raising their policy rates, overreacting to oil prices, thinking they're going to be inflationary when there was absolutely no chance that was going to be the case. So in the short run, you had interest rates that rose, including U.S. Treasuries, because there were a lot of indications from Ben Bernanke after Bear Stearns and really May and June of 2008 that the Fed was going to follow the ECB and start hiking rates in the middle of 2008. So you had Treasury yields that were way down during Bear Stearns and immediately after, and the 2-year rose. I think it was 160 basis points in a matter of just 6 weeks. Once in one period, I think it was just a week, the 2-year Treasury rate went up about 70 basis points, 60 or 70 basis points. I'm going off the top of my head, so don't quote me. But there was a huge rise in interest rates in the middle of 2008 because, like today, many central bankers were overreacting to oil prices and underreacting to the fundamentals of the economy and the financial system, which were still in tremendous difficulty. So in 2026, depending on how oil prices go from here, thank God we got a ceasefire agreed to and oil prices have come down. But even so, it's very likely that a central bank, maybe two, are going to hike rates in the short run before, just like 2008, they end up having to turn around and drop them because historically energy shocks lead to recessionary conditions, not inflation condition. So if the question for us here in 2026 is whether or not the oil price shock was, first of all, high enough in terms of how high oil prices got to be, and did they last long enough to create the sort of damage that leads to something like a full-blown recession? We're seeing rising unemployment on top of the rising unemployment that we've had over the last couple of years. So even if central bankers do hike rate in the short run, it's not going to last very long. They're going to turn around and go back down to rate cuts at some point anyway.
Oh, that's actually encouraging. So in your mind, we could see rates go down. What happens if, we're hearing, and we're at Limitless this year, we're really gearing up for some of these AI experts, AI panels to really kind of dig into how to use it, but two, what is it going to really do? How's it going to ripple through the economy? Where's it going to hit first? And so the question would be, if the Fed is now facing these rising unemployment pressures, will that affect interest rates on the other side of the equation?
Yeah, there's also, we always keep in mind that the market interest rates and the Fed policy rates are oftentimes two different things. Market interest rates, which is where mortgages come from. Mortgages are priced off of U.S. Treasuries, you guys know. Market interest rates are heading lower, not quite regardless of what the Fed does in the short run, but market interest rates want to go lower. There's always that natural tension between what the Fed does, which oftentimes, like I just said in 2008, is in the conflict with reality. So it really is how much time and space central bankers have to do really stupid things. Like 2008, they didn't really have much runway because the whole system just fell apart within a matter of weeks after the ECB raised rates. It might have, the situation is not nearly as bad in the middle of 2008 as it is in 2026 as it was in 2008. So you can see central bankers raise rates in the short run, their rates at the same time market rates would be reacting to fundamentals and coming down even before the Fed reacts. So it's really kind of the same process in interest rates that we've seen over the last several years. What has happened since 2023 when rates peaked? The market moves first. Then the Fed reacts to the same things that the markets were predicting, because eventually the Fed sees what the market was pricing to begin with. 2024 is a perfect example. Everybody was talking about sticky inflation. The Federal Reserve was doing so. They were talking about the employment reports that looked absolutely spectacular, which we know now they never were. And the market was saying, no, we're seeing more and more real world consequences for the weak economy in the aftermath of the banking crisis, plus the oil shock that was ongoing back then, leading to companies that were struggling. Therefore, hiring was falling off really sharply. It's really started the labor market difficulties that we see today. So the market was well ahead of the Fed in lowering interest rates, and then wasn't until September of 2024 before the Fed finally started to catch up. And then in 2025, as we know, the Fed stopped again, but the market in the summer of 2025 started to price rate cuts and really rates going down lower because the further development of the weak labor market, job losses started to show up a little bit more frequently and a little bit more intensely. So the market was well ahead of the Fed yet again. And of course, the Fed latter part of the year, almost same exact pattern as 2024. They lowered rates at the end of the year. Now here we are once again, Fed talking about maybe hiking rates, maybe holding them up. And the market is like, no. You remember before we got to March, before the Iran conflict, rates were going down. The 2-year Treasury, I think it was February 27th, again, going off the top of my head, late February, the 2-year Treasury hit a multi-year low just before the Iran conflict started. So rates were starting to move back down. And this is not just in U.S. Treasury, it was globally. Safety rates were starting to go back down again, which was, for the third straight year, the market saying rates want to go down, fundamentals in the economy for lower rates, and the Fed holding up likely throughout the summertime if there was no energy shock. And then maybe by September, yet again, for the third straight year, the Fed catches up to where the market was earlier part of the year. So that's where we were before we even got to the energy shock. And the energy shock is very likely to make the situation in the real economy worse, more financial volatility. We're seeing dollar shortages erupt across Asia, which adds a little bit more of a deflationary element to it. So the fundamentals in the real economy argue for lower rates, regardless of what the Fed does in the short run. And eventually policymakers end up catching up down the road.
So help me out here on one thing, right? So the one of the biggest reasons why I started doing the Limitless Expo with Ken is so I could talk to guys like you, and so I can learn selfishly. Like, I want to learn. What is my family going to do with all the information you said? Like, what am I going to do with all the information you said? So let's play a scenario here that everything you said, like along the lines, rates go down, energy crisis happens with all that stuff, right? Like, you have unemployment goes up, right? The private banking and the debt wall collapses. Like, what if all that happens? Like, what should I be thinking about investing in? What should I be thinking about placing tactically? Like, what should I be doing to hedge? Like, what can I do today to maybe prep for all the worst case scenarios that maybe you're predicting in some capacity?
Well, just from general terms, you want to be more defensive. I mean, I think that's the most obvious thing. There's no insight in that statement. If everything happens, or even just half the stuff that you listed off happened, you want to be more defensive. And there's a number of different ways you can do that. If you're a very simple retail investor, the easiest thing to do is stay away from anything risky and just buy treasury bills. You can roll over treasury bills completely risk-free. You get a little bit of a return. It's not something spectacular, but at least you can sleep at night. You can say, I don't care what happens as far as the unemployment rate. I don't care what happens to Blue Owl. None of that bothers me. I'm just going to roll over treasury bills until we get to the other side of this thing. And that's where it's much easier to make more risky investments, because if we do go through all of these things, what ends up happening is asset prices get revalued, which means they go down. Yep. And at that point, you're going to want to be there and ready to take advantage of lower prices. You want to go bargain shopping. You want to go want to go really deep into the bargain bin in those periods, because after prices go down on anything, doesn't matter what it is, the stock market could go down. I know people are probably shaking their head because they're conditioned to believe the stock market never goes down, but it can absolutely go down. And there you'd have the opportunity to buy some stocks relatively cheaper. Credit, most people make their fortunes in distressed credit after a cycle completes, after you go through a downswing in a credit cycle, after everybody has panicked, after all the forced sales are tallied up and all the debt prices are down to pennies on the dollar. That's where you really make your money, because you can scoop up some of those distressed credit opportunities. The portfolio that performs in one economic regime can get crushed in the next. So in this free webinar, we're going to reveal what those 4 economic regimes are, how to identify them, as well as the assets, historically speaking, best positioned to perform in every environment. So reserve your seat now and learn how to prepare your portfolio before the economy shifts again.